Okay, this is a paper called Fact, Fiction, and Momentum Investing. It's written by Clifford Asness, Andrea Frazzini, Ronan Israel, and Tobias Moskowitz. These three are from AQR Capital Management, and Mr. Moskowitz is from the Booth School of Business. It was published in the Journal of Portfolio Management in the fall of 2014. So let's jump into it here. The introduction. So they start out with the definition of momentum, where the securities that have performed better than their peers over the past period, called the winners, will continue to outperform their peers going forward, and the opposite is true, where the securities that have underperformed in the relatively short past will continue to underperform their peers. And there's been academic research that's empirically found that momentum is an anomaly that exists going back 212 years. And it exists in 40 other countries and more than a dozen asset classes. So we can consider it to be a true anomaly that works across all time periods, geographies, assets. And there's been some evidence that momentum has existed way before we even started studying, since the beginning of markets. But the authors have found that there are a lot of myths surrounding momentum and how it works. For instance, some researchers say it's too small and sporadic a factor to use, or it's mostly a short side strategy, or maybe that trading costs will take up all of the potential profits. And others say that it's better used as a screen rather than in an actual investment process. And others argue that the investment strategy isn't a true strategy, but more kind of a game. And so the authors have expressed some concern over these myths, and they want to resolve those. And so they're going to use academic papers that have been circulated through the communities. They're going to use seminars, conferences, and other peer-reviewed journals to confirm the effectiveness of momentum strategies. And they caution that this paper should resolve all of those myths that have come about in recent years. And they want to caution that momentum strategies certainly don't work all of the time, especially in the past few years. It's had a difficult time. And they argue that it's merely a factor, just like the size or value growth premium factors, and it's had an impressive long-term success of the strategy. And so in this paper, they're going to defend momentum, including its standalone strategy, as well as combining it with value to combat the attacks from naysayers. And they reiterate that although they're focusing on momentum here, it's not the only factor that can contribute to returns. So they want to caution that you should pay attention to the other factors. And as they'll show in this essay, value and momentum work better as complements than they do as replacements of one another. So typically, value and momentum strategies will select opposing stocks. For instance, momentum are typically growth companies, and which will have very high price to book, price to earnings, low dividend yields, that sort of thing. And then value companies will be the opposite, with very low price earnings ratios, price to book, very high dividend yields. And so it seems counterintuitive to choose both a momentum and a value company, because they're typically different types of companies. But the authors here are going to explain how momentum and value, if the stocks in the portfolio contain both of these types of characteristics, it usually provides the best overall strategy. Okay, so let's jump into a few of these myths. I think they have 10 total. So the first myth is momentum returns are too small and sporadic. So it looks like here they're going to start out with gross of costs. That means the returns before they deduct the costs related to trading and management, and long short portfolios where they've bought a piece and sold short a piece of the portfolio to kind of get a baseline result. And later sections are going to debunk myths related to shorting and transaction costs and long only strategies. And so here the myth is that returns are too small and they don't particularly happen all the time, and so that would mean that it's kind of not a very good strategy to follow. But the authors here are finding in prior research that the momentum strategy's presence and robustness are remarkably stable, and by that phrase they mean that momentum strategies don't have huge underperformance or huge overperformance. It's relatively steadily good performance over the time periods that have been studied. And in the U.S. markets, this has been found over very long time periods, even after it was, quote, discovered in the 90s. And so even out-of-sample studies have found it to be true, and it looks like they're going to do an out-of-sample study here. And the momentum strategies have even been found to exist in other countries, other stock markets, other asset classes such as bonds, currencies, commodities. So it seems to be everywhere and not just a sporadic incident. So it looks like here the authors are going to redo some of the prior studies, especially using Ken French's data from his website. Okay, so it looks like in their study they're going to create a four-factor model with the market return factor, small minus big, the high minus low, and the up minus down. So the market risk premium piece would be the average equity market returns minus the risk-free rate and the return spread related to that. So it would tell you how the market returns explain the returns of this particular strategy. Small minus big would be small companies minus big companies, the returns of those, as if you went long small stocks and went short big stocks to capture the size effect. There's also a high minus low factor, which relates to the book to price of stocks. So high book to price stocks minus low book to price stocks, and that would tell you how investing in the value companies would explain the returns here. And we have an up minus down, which is the momentum piece or the momentum factor. And so the up would be the returns over the past year that are positive, and the returns over the down would be the returns over the past year that are negative. And that would tell us how much the returns are explained by momentum. Anyway, so table 1 describes or presents a lot of the data from this study. So let's take a look at table 1. So here we have the market premium, small minus big, high minus low, up minus down. And this is the returns. And then we have over here different periods, different regimes, I suppose. Okay, so the reason he picked these periods is 1927 is as far back as Ken French's data goes. 1963 is about the time that Fama and French's 1993 paper begins their analysis, and 91 kind of begins the out-of-sample period. This would be the period after the momentum strategies were, quote, discovered. So you would think that if the markets are efficient after the discovery of the momentum strategies, this time period wouldn't be as profitable for momentum strategies. But let's take a look at the returns here. These are basically just all the spreads that we just described, as if you went long one piece and went short the other piece to see which returns more. And so we can see that the market returned more than the risk-free rate in all time periods by about 8%. Same thing for the small minus big. Small companies outperformed large companies over these time periods by about 3%. Same thing for high minus low. Value companies outperformed growth companies by about 4 to 5% over these different periods. And momentum strategies, where we bought past winners and sold past losers over these time periods, outperformed over the past about 6 to 8% over the time period studied. And we can see over here the Sharpe ratios associated with these, and this would be the excess returns divided by the standard deviation of those returns. So we can see here that momentum strategies significantly outperform, with winners outperforming past winners outperforming past losers. We did see once we got out into the out of sample period, the spread went down by a little bit, but it's still pretty significant. And in fact, the Sharpe ratio, which would give us a feel for the return out of the risk that is being taken, exceeds all of the other factors. And so, as more evidence against the claim that momentum strategies are sporadic, the authors offer Table 2, which gives kind of a more pragmatic way to understand how sporadic the returns are. It looks at the percentage of times each strategy generates positive returns. So the percentage of times that longs beat the shorts and so forth. So let's look at Table 2 here. And so these are 1 year rolling returns. So what percentage of the time did the market return exceed the risk-free rate over a 1 year period? And it was about 70 or 80% of the time. Small companies exceeded the returns of big companies about 60% of the time, 60% of the years studied. High minus low, so value stocks exceeded the returns of growth stocks about 60% of the years studied. But momentum strategies, where the past winners exceeded the past losers' returns about 80% of the years studied. So that's a lot more than the other strategies. Also on a 5-year rolling return, so what percentage of the time did the 5-year returns exceed from the spread? We see something similar here where the market exceeded the risk-free rate about 70-80% of the time. Small companies exceeded the big ones 60 to 70% of the time. The value companies exceeded the returns of growth companies about 70 to 90% of the time. And same thing for momentum strategies, where the past winners exceeded the returns of past losers about 70 to 90% of the time. And the authors note that since the momentum strategy was profitable 90% of the 5-year periods, we could, throw away the notion that the returns are sporadic. And so, since the value returns were similar to the momentum returns, the authors are now going to look at using value and momentum strategies together and that's down in table 3. And so here they're going to pretend like they built a portfolio that has 60% of its weight in high minus low portfolio and 40% of its weight in the momentum portfolio. So let's see what would have happened in that strategy. We see here with the combined portfolio, the Sharpe ratio is significantly higher. It's double what the high minus low portfolio was in itself. The percent positive years, the 1 year rolling or the 5 year rolling, was 80% and 90% respectively. So that this portfolio is significantly outperformed each of the factors alone. And so we found the claim that momentum returns are small and sporadic is likely false. The returns that we saw from the spread of winners and losers exceeded the returns of the market and value growth strategies, etc. And they weren't just over certain periods or regimes. They went back to 1927 and even in out of sample periods. So the authors argue that if people are claiming that momentum is small and sporadic, then they're going to have to throw size, value, and the equity premium into that bucket as well. And of course, researchers and practitioners aren't going to say that the size, value, and market premiums are small and sporadic. So we can probably say that that myth is debunked. Okay, so let's take a look at myth number 2. Momentum cannot be captured by long-only investors, as momentum can only be exploited on the short side. So what this means is when we're using the up minus down piece, which is the long the past winners and short the past losers, they're saying that all of the excess of the spread is actually from being short the losers, and being long the winners doesn't contribute much to the excess spread. So the authors argue that that conjecture is false. So to disprove this myth, they take Kim French's momentum factor, which is the up minus down, and they're going to look at the alphas of the up and the down separately. So to get the alpha, it looks like they're going to use a one-factor model regression, and so any of the return that is not included in this market factor, the market return minus the risk-free rate, any of the return that's not composed of that piece would be considered the alpha piece. And so we're going to look at the alphas of the long and the short piece, and that's down in table 4. And so here we have the alpha piece, which would be the market adjusted returns. So we see that in total the up minus down alpha is about 10.6%, and over the whole time period, and then in the sub periods decreases a bit, but this is made up of about the short side, or about half the short side and half the long side. So this is basically the profit that you would have made by shorting the losers, and this is a profit that would have been made by going long the winners, and we can see it's about half and half, and that's shown here in this column. And also looking at the as if you had used the up minus down strategy and subtracted it minus the market return, these are the returns that it would have been made. So we see a slightly lower return in the momentum strategy, but about the same. And now even the long side significantly exceeds the short side's returns, and so the sum of those equals this total. But we see that 70 to 80% of this momentum strategy's return is coming from the long side. So that certainly debunks the myth that all of the return comes from shorting the losers. So in fact, investors can earn significant returns from momentum strategy and long-only strategies. And the authors note that an Israel Moskowitz study in 2003 found that the long and the short sides of momentum strategies are equally profitable over 86 years of U.S. data, 40 years of international equity data, and 40 years of data from 5 other asset classes outside of equities. And everywhere they looked, they could not find a place where the short side was more profitable than the long side of momentum strategies. And so we could conclude here that momentum does not work better or only on the short side, and it also works very well on the long side.